There is a number sitting on the Federal Reserve's own balance sheet right now that most Americans have never heard of, and it might be the most important number in the entire global financial system. Gold on the Fed's books is still valued at $42.22 an ounce, not $4,000, not $5,000, $42.22. That number was set in 1973 and it has never been updated. Meanwhile, gold is trading near $4,000 an ounce in the real world. Do you understand what that gap represents? It represents roughly $1 trillion in unrealized value sitting quietly on the government's books, unrecognized, unspent, and untouched. And in a year when the federal government is paying more in interest on its debt than it spends on national defense, that gap is starting to look less like an accounting footnote and more like the most tempting lever in Washington. I want to walk you through something today that sounds like it belongs in a conspiracy forum, but every piece of it is sitting in official documents, central bank research papers, and financial filings that anyone can pull up. It is the growing conversation inside the Treasury, inside the Federal Reserve, and inside serious institutional research desks about revaluing America's gold reserves, not confiscating anyone's gold, not banning ownership, revaluing the number the government uses to price the gold it already holds, and what that would trigger for the dollar, for your savings, and for the gold and silver sitting in your portfolio or your safe deposit box. By the end of this video, you are going to understand why Comex inventories have been moving in a way that has commodity desks talking, why silver just did something it has not done since 2011, why the new Fed chair's first few months in office matter more than almost anyone realizes, and why some of the largest institutional research shops on Wall Street are now putting price targets on gold that would have gotten you laughed out of the room 3 years ago. So stay with me, because this is not hype. This is the actual mechanics of how a monetary system starts to bend under its own weight. Let's start with the debt, because you cannot understand any of this without understanding the debt. As of this spring, total gross federal debt crossed roughly $39 trillion. That is not a controversial number, that is just the number. What is more interesting is the trajectory. The Congressional Budget Office is projecting the annual deficit to nearly double over the next decade, and the single fastest growing line item in the entire federal budget is not defense, it is not healthcare, it is interest. The government paid close to $1 trillion in interest costs last year alone, and in April of this year, a single month, interest payments hit a record above $110 billion. Think about that. $110 billion in a single month just to service debt that already exists, before a single new dollar is spent on anything else. When a government reaches a point where it cannot tax its way out, cannot borrow its way out cheaply anymore because yields keep climbing, and cannot quietly inflate its way out without the bond market noticing, it starts looking at what else is sitting on its balance sheet. And the most obviously mispriced asset in the entire United States government's possession is its gold. The U.S. officially holds well over 260 million ounces of gold, most of it sitting in vaults, including the one everyone loves to talk about, Fort Knox. At the official book value of $42.22 an ounce, that gold is worth next to nothing on paper. At the real market price near $4,000 an ounce, that same gold is worth well over $1 trillion. Revalue it, and the Treasury's asset side of the balance sheet instantly looks stronger, without raising a single tax or cutting a single program. Gold on the Fed's books is still valued at $42.22 an ounce, while gold trades near $4,000 in the real world. This is not a new idea invented by internet gold bugs. In 2025, the Federal Reserve itself published a research paper titled Official Reserve Revaluations: The International Experience. Read that title again. The Fed studied how other countries have revalued their gold reserves and what happens when they do. The paper walks through exactly how a revaluation increases a central bank's assets and how those valuation gains can be transferred to the government's account. This is a real academic exercise being done by the people who run the plumbing of the American financial system. When the Federal Reserve is publishing research on how other nations have already done this, you have to ask yourself why they are studying the homework instead of just filing it away. And this has happened before in American history more than once. In 1934, in the middle of the Depression, the government revalued gold from $20.67 an ounce to $35 an ounce. That was not a small move. That was a 69% devaluation of the dollar against gold, done by policy overnight. In 1973, the price was moved again to the $42 figure we still use today. Both times, the government used gold repricing as a tool to reset the value of the currency without going through the political nightmare of raising taxes or slashing spending in a crisis. History does not repeat perfectly, but it absolutely rhymes, and right now the fiscal math looks eerily familiar to those two earlier moments. Now let's talk about what has actually been happening with the physical metal itself, because this is where it stops being theory and starts showing up in real flows. Reuters reported that gold has been moving out of London vaults and into United States Comex warehouses at a striking pace, with Comex gold stocks climbing over 100% in a recent stretch while London reserves fell to their lowest level in 5 years. The World Gold Council flagged the same pattern, tied initially to tariff concerns rippling through global trade. When you see physical bullion physically relocating across an ocean into vaults on U.S. soil, that is not a headline, that is a signal. Someone somewhere wants that metal sitting inside American jurisdiction rather than London's. At the same time, there has been renewed political pressure to actually open up Fort Knox and audit what is really in there. The last full, independent physical audit of America's gold reserves happened generations ago. For decades, skeptics have asked a simple question: if it is really all there, why does nobody outside a small circle of officials ever actually verify it with modern methods? This year, that question has gotten louder, with public calls for a fresh review. Whether or not that audit happens, and whether or not it confirms every last bar, the fact that the conversation has moved from fringe blogs into mainstream financial reporting tells you something about where sentiment is heading. Here is a question worth sitting with for a second. If you were running the Treasury and you had $1 trillion unrealized gain sitting on your books that nobody was using, and your interest bill was eating your budget alive, would you leave that gain on the shelf forever? Or would you eventually find a reason to recognize it? Let's move to central banks, because this is not just an American story, it is a global one, and the global numbers are honestly staggering. Central banks around the world have been buying gold at a pace of roughly 1,000 tons a year for several years running, the strongest sustained buying in modern history. China's central bank just reported its largest monthly increase in gold reserves in more than 2.5 years. According to recent European central bank estimates, gold now makes up about 27% of global official reserves, while U.S. Treasuries have slipped to around 22%. Read that again. For the first time in decades, gold has overtaken U.S. government debt as the preferred reserve asset among the world's central banks. That is not a small rotation. That is a structural shift in how nations choose to store their national wealth, and it has been happening quietly in official filings while most retail investors were focused on stocks. Why would central banks do this? Because they are watching the same debt trajectory we just walked through, except they are watching it from the outside as holders of U.S. Treasury debt themselves. If you are a central bank sitting on hundreds of billions in U.S. bonds, and you watch America's interest bill hit records every single month, you start asking whether you want your national reserves parked in a currency whose issuer is running deficits that widen every single year. Gold does not default. Gold does not get printed into oblivion. Gold has been money for 5,000 years, regardless of who is in the White House or the Fed chair's office. That is exactly why central banks keep buying it, even at these elevated prices. Now let's talk about the Fed itself, because leadership at the central bank matters enormously here. There is a new Fed chair in office this year, and his early public comments have already started shifting rate expectations. When policymakers signal that inflation risks and expectations have cooled and that there is no urgency to hike aggressively, that is effectively a green light for gold, because gold competes directly with the yield you can earn holding cash or bonds. Lower real rates, or even just lower expectations for future rate hikes, historically pull money toward non-yielding assets like gold and silver, because the opportunity cost of holding them goes down. Watch what this Fed does with rates over the second half of this year. It may end up being the single biggest swing factor for where gold goes next, more than any headline about Treasury revaluation. For the first time in decades, gold has overtaken U.S. Treasuries as the world's preferred central bank reserve asset. Let's bring it back to price, because you deserve the actual numbers, not just the narrative. Gold set an all-time high earlier this year above $5,500 an ounce, an extraordinary run that left even longtime gold bulls stunned. It has since pulled back and has been consolidating in the $4,000 to $4,200 range, still up more than 20% from where it stood a year ago. Some of that pullback has come from a stronger dollar and shifty geopolitical headlines, including renewed tension in the Middle East that has whipsawed both oil and gold in recent weeks. Institutional research desks are not walking away from the bull case, though. One major asset manager's recent monthly outlook projected bullion could rally toward $4,700 to $5,500 an ounce over the next 6 to 9 months, citing the same reserve rotation and fiscal dynamics we just discussed. Silver is where this story gets even more dramatic, and honestly more interesting for anyone paying close attention. Silver spiked above $93 an ounce earlier this year, an all-time high, before correcting sharply on the order of 7% in a single session when some tariff-related pressure eased. Even after that pullback, silver remains up well over 25% for the year, and depending on the exact window you measure, up close to 150% over the trailing 12 months. That is not a typo. Silver has dramatically outrun gold. And here is the number that really tells the story. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has fallen to just above 50. That is the lowest that ratio has been since 2011. Historically, when that ratio compresses this fast, it means silver is catching up to gold's move, sometimes violently, because silver's market is so much smaller and thinner than gold's, which means the same dollar of buying pressure moves silver's price far more than it moves gold's. Why is silver behaving this way? Because unlike gold, silver has 1 foot in the monetary world and 1 foot in the industrial world, and both of those feet are currently pushing in the same direction. On the monetary side, it is riding the exact same safe haven and de-dollarization currents as gold. On the industrial side, silver is a critical input for solar panels, electric vehicles, and electronics, and demand from those sectors keeps climbing even as mine supply barely grows. Most silver is not even mined directly. It comes as a byproduct of mining other metals like copper, lead, and zinc, which means silver producers cannot simply ramp up output when prices rise the way an oil producer might open another well. That structural mismatch between rising demand and inelastic supply is exactly the kind of setup that creates sustained deficits, and the Silver Institute has been flagging exactly that kind of deficit for several years running now. Have you noticed how quiet the mainstream financial media has been about this ratio move? It rarely gets the same airtime as a Dow record or a tech earnings beat, but for anyone tracking the metals market closely, A 50-year low crossing on the gold-silver ratio, alongside a record high in silver itself, is one of the more significant technical events we have seen in over a decade. There is another piece of this puzzle worth understanding, and that is where the buying is actually coming from geographically, because it is not evenly spread across the world. Asian demand, and China in particular, has shown a distinct pattern this year. Local gold price premiums in China climbed to some of their highest levels since early last year, which tells you domestic buyers there have been paying up for physical delivery rather than waiting for a dip. That regional premium data matters because it is a real-time signal of physical demand, not just paper trading sentiment. Meanwhile, some Western fund investors, the ones holding gold through ETFs rather than physical bars, have actually been net sellers in recent months, taking profits after the run to record highs earlier in the year. So you have this interesting split happening in real time. Western paper money trimming exposure after a historic rally, while Eastern physical buyers keep accumulating on any pullback. That kind of divergence, physical demand strengthening even as speculative paper flows cool off, has historically been a sign of a market transferring from weak hands to strong hands, not a market topping out for good. India tells a similar story from a different angle. As one of the largest physical gold-consuming nations on Earth, Indian demand tends to move with cultural and seasonal patterns around weddings and festivals, but it also responds to affordability. When prices run this far this fast, you sometimes see a temporary pause in Indian retail buying simply because the price per gram has become a genuine budget constraint for average households, only for that demand to return once prices consolidate. Watching how that demand behaves over the back half of this year will tell you a lot about whether this rally has staying power at the retail level, not just among central banks and institutions. The gold-to-silver ratio has fallen to its lowest level since 2011, a signal silver historians do not ignore. Let's talk about the paper market for a moment, because this is where a lot of the more dramatic online chatter comes from, and it deserves a clear-eyed look. There has been unusual activity in Comex gold options this year, with open interest building meaningfully in call options struck at levels like $10,000, $15,000, and even $20,000 an ounce for December expiration. Now, before your eyes widen too much, understand what that actually means. Those are extremely out-of-the-money bets, essentially long-shot lottery tickets that most professional traders use as cheap hedges or speculative flyers, not as serious price targets. But the fact that open interest at those strikes has been climbing steadily, not shrinking, tells you that a growing number of market participants are positioning for the possibility of an extreme, low-probability, high-impact event. You do not need to believe gold is going to $20,000 to find it meaningful that increasing numbers of sophisticated traders are willing to pay for that kind of insurance. Would you buy gold or silver at these levels after this kind of run? That is honestly the question every viewer of this video should be asking themselves right now. And I am not going to pretend there is a single right answer, because there is not. Let's walk through both sides honestly, because a lot of channels covering this topic only give you the bull case, and that is not analysis, that is marketing. Here is the bear case, and it is a real one. Gold and silver do not pay you a dividend or a coupon while you wait. Every dollar sitting in bullion is a dollar not compounding in a productive business or earning yield in a bond. If the Fed does end up hiking rates later this year, as some FedWatch pricing still suggests is possible, that raises the opportunity cost of holding non-yielding metal and could pressure prices lower in the short run. We have already seen how sharply metals can correct. Silver's single session drop above 7% earlier this year is a perfect example of how fast sentiment can turn when a geopolitical risk premium unwinds. Gold ETF flows have shown real redemptions in recent months too, meaning some Western institutional money has actually been heading for the exits even while central banks keep buying, which tells you this is not a one-directional trade with no risk. And skeptics of the whole revaluation thesis will rightly point out that Treasury officials have made no formal announcement of any plan to reprice gold reserves. Everything we have discussed today about a formal revaluation remains for now informed speculation built on research papers, historical precedent, and fiscal pressure, not a confirmed policy decision. Anyone telling you it is already a done deal is getting ahead of the actual facts. Here is the bull case, and it is equally real. The debt trajectory is not improving under any current policy path from either party, and interest costs compounding at record levels create exactly the kind of pressure that has historically pushed governments toward unconventional balance sheet solutions. Central banks are not buying gold because they read a headline. They are buying because their own risk models are telling them to diversify away from concentrated Treasury exposure, and that buying has been remarkably persistent through multiple market cycles now, not just a short-term reaction. The physical movement of metal from London to Comex vaults, the loudest calls in a generation for a Fort Knox audit, and a Federal Reserve research paper studying how other nations have executed reserve revaluations, taken together, are not proof of an outcome, but they are proof that serious people inside serious institutions are seriously preparing for the possibility. So is this rally sustainable? I think the honest answer is that the monetary and fiscal backdrop driving this move is not going away anytime soon, regardless of week-to-week price swings. Deficits do not fix themselves in a single election cycle. Central bank reserve diversification does not reverse in a single quarter, and the structural silver deficit, driven by solar and electric vehicle demand growing faster than mine supply, is a multi-year story, not a headline that fades by next month. That does not mean the path higher will be a straight line. We just watched gold pull back roughly $700 from its January peak, and silver correct sharply from its own record high. Volatility, especially in silver given its smaller market size, is going to remain a defining feature of this trade, not an exception to it. If you are someone who wants clear, research-based gold and silver analysis instead of market noise and clickbait predictions, make sure you are subscribed, because breaking down exactly this kind of story, with real sources and real numbers, is what we do here every week. Let's zoom out for a second and talk about what this actually means for someone watching this video who is not a hedge fund manager, who is just trying to protect what they have built. The lesson from 1934 and 1973 is not that gold ownership makes you rich overnight. The lesson is that when governments run out of conventional tools to manage overwhelming debt, the value of the currency itself becomes the adjustment variable. Whether that happens through inflation, through a formal devaluation like a reserve revaluation, or through some combination of both playing out over years. People who held real hard assets through those earlier transitions preserved purchasing power. People who held only cash and cash equivalents did not. That is not speculation, that is simply what the historical record shows. Could this be a trap, a moment where sentiment and price have run so far ahead of fundamentals that anyone buying now is buying the top? It is a fair question, and the honest answer is that nobody, including the largest banks on Wall Street with the most sophisticated models in the world, can time a market top with precision. What you can do is understand the underlying drivers well enough to judge whether they are strengthening or weakening. Right now, based on everything we just walked through, debt trajectories, central bank buying patterns, the structural silver deficit, and the growing seriousness of the revaluation conversation at the highest levels of policy research, those underlying drivers look like they are strengthening, not weakening. That does not eliminate risk. Nothing eliminates risk. It simply tells you which direction the fundamental pressure is pointing. I genuinely want to hear your take on this. Do you think Washington eventually pulls the revaluation lever, formally repricing gold reserves the way it did in 1934 and 1973? Or do you think the political and legal complications make that too difficult, and the real story stays confined to central bank buying and market forces alone? Drop your honest opinion in the comments, because this is exactly the kind of debate where reasonable, informed people can land in very different places, and I want to see where you stand. It is also worth stepping back and asking who actually benefits and who gets hurt if a revaluation ever did happen. A government sitting on newly recognized trillion-dollar gains gets fiscal breathing room without a single vote on a tax increase, which is exactly why the idea is politically attractive regardless of which party controls Washington at the time. Holders of physical gold and silver would likely see the market price adjust further to reflect the new reality of a government openly treating gold as a serious monetary asset again rather than a $42 relic. But savers holding only cash, only short-duration bonds, or only dollar-denominated assets with no hard asset exposure at all would effectively be absorbing the cost, because their purchasing power would be the thing quietly adjusting downward while the government's balance sheet adjusted upward. That asymmetry is exactly why this conversation matters to you personally, not just to policymakers in Washington or portfolio managers on Wall Street. This is not an abstract macro debate happening somewhere far away from your life. If it plays out the way it has twice before in American history, it changes the value of every dollar in every checking account in the country. Before we wrap up, a word on risk management, because no analysis like this is complete without it. Nobody should be putting a life-altering percentage of their savings into any single asset class based on a YouTube video, including this one. Precious metals have historically played a role as a hedge and a diversifier within a broader portfolio, not as a replacement for one. Position sizing, time horizon, and your own personal financial situation matter more than any price target any analyst, including the ones running the largest research desks in the world, can give you. Do your own research, understand what you own and why you own it, and make decisions that fit your actual life, not just the excitement of a chart. If this kind of deep-sourced breakdown of what is actually happening in the gold and silver market is useful to you, take a second to like this video and share it with someone who still thinks this is just internet noise, because the numbers we walked through today, the debt figures, the central bank data, the Federal Reserve's own research paper, the Comex inventory flows, they are not noise. They are sitting in official documents right now, waiting for more people to actually read them. Here is the single biggest takeaway I want you to leave with today. The $42 figure sitting on the Fed's books is not just an outdated accounting entry, it is a trillion-dollar decision waiting to be made, and the pressure to make it, fiscal, political, and historical, keeps building every single month that interest costs set a new record. Whether that decision comes this year, next year, or further down the road, the direction of the pressure is unmistakable, and the central banks of the world have already made their own decision, buying gold at the fastest sustained pace in modern history. Watch the debt numbers. Watch the central bank buying reports. Watch what happens the next time Fort Knox comes up in a congressional hearing. Those three threads are going to tell you more about where gold and silver go next than any single headline ever will. I will be back soon with the next piece of this story, because there is a lot more happening beneath the surface than any one video can cover. Until then, take care of yourselves and take care of your money.